Right, bad news coming in from the aviation sector. Sad news, rather. The second plane crash in just the last 5 months, and all passengers confirmed dead. But with that, we will take a look at how the Asian markets are panning. Actually, the Asian markets are in the red amidst rising global growth concerns. So if you take a look at the Nikkei, it has come off the highs of the day after opening fairly well in the green. Further pressured, the Nikkei is by the strength that we're seeing in the dollar yen. Remember, there was some weakness coming by in the dollar. As a result of that, the dollar yen has strengthened closer to levels of 111. This compares with previous week levels of around 112. Not so good news for the Japanese exporters, further in a weakening global growth environment. Other than that, we have the Korean markets also mildly in the green, mildly in the red after opening in the green. So sitting with a cut of about 1/5%, similar to the sort of cut that we're seeing for the Straits Index as well. So the Straits currently sitting with a cut of around 1/5%, similarly as the Taiwanese Index. In that regard, the Indian markets, the SGX Nifty indicates a cut of close to around 17 to 18 points, which is about, again, 0.16 to 0.2%. And that is an outperformance as compared to the other markets as well. Remember, all through last week, the SGX Nifty did outperform the world. In fact, over the last 15 days itself, our markets have been outperforming the world. Let's see, in a scenario where the global growth concerns persist, will the domestic market stand out or not? Because a byproduct of that is, of course, stable crude, which is currently around $65 per barrel.
All right, then let's talk about the U.S. markets. Wall Street ended with losses for the 5th straight session as jobs data misses expectations, adding to the concerns of a slowing global economy. Big U.S. tech companies also under pressure on the back of potential policy intervention from Senator Elizabeth Warren. CNBC's Dredri Bosa gets us a wrap of all the action on Wall Street.
For CNBC-TV18, I'm Deirdre Bosa. Major U.S. averages slightly lower, closing well off their worst levels of the day. The Dow slipping 22 points, the S&P off 5, and the Nasdaq down 13 points. The U.S. adding just 20,000 jobs in February, well below economists' expectations of 180,000, marking the worst month for job creation since September of 2017. There was some good news, though, with the unemployment rate falling slightly more than expected. Wages also climbing by their best margin since the economic recovery began almost 10 years ago. Senator Elizabeth Warren reigniting her push to break up big technology companies like Amazon, Facebook, and Apple. On Friday, the Democratic senator from Massachusetts unveiling her plan in a blog post. Warren said tech companies today have too much power, and she wants to make big structural changes to promote more competition. And shares of Costco popping about 5% Friday. The wholesale retailer beat earnings estimates late Thursday and announced plans to boost its starting wages to $15 per hour in both the United States and Canada. That's the action from the U.S. market. Back over to you in Mumbai.
Right, that was the action from the U.S. market, but the big data shocker came in from the jobs world. The United States jobs data did shock. The American economy added just 20,000 jobs in February. This versus expectations of 1.8 lakh new jobs. This follows the longest government shutdown in the United States history, combined with an adverse weather condition. All of that impacted the jobs data. The disappointing data has now taken a toll on Wall Street as well, with key indices seeing sharp losses on Friday's trading session. So let's go across to CNBC's Elan Mui for more. Elan?
Payrolls rose by just 20,000 jobs in February, way below expectations. The unemployment rate declined by 0.2 percentage points to 3.8%. On wages, average hourly earnings spiked 11 cents in February to $27.66. That's a 0.4% increase over the month, and over the year, it's a 3.4% gain, the biggest gain since April 2009, almost a decade. Now, for revisions, January's blockbuster job growth number, that was revised upward from 304,000 to 311,000 jobs. December's number was also revised up from 222,000 jobs to 227,000. So that is 12,000 more jobs that had previously been reported. The 3-month moving average for job growth is now 186,000 jobs. Now, February's weak job growth was really driven by two key factors. One, the construction sector. That industry said 31,000 jobs. Meanwhile, leisure and hospitality hiring was flat there. No jobs were added after the sector posted an 89,000 job gain in January. Now, the data also show that the decline in the unemployment rate was largely due to the end of the government shutdown. There were about 300,000 fewer unemployed persons in January. That's the result of people going back to work after the shutdown, and that's what drove down the unemployment rate. Meanwhile, labor force participation, that rate held steady at 63.2%. Guys, back to you.
All right, let's also hear out what the economy experts make of the job data numbers.
You don't want to read too much into one number. You want to be looking at this. We'll want to be studying the details of this. The unemployment rate remains low. Wage growth remains strong. You want to average numbers like this over a couple months. This does partly resolve that thing that was puzzling me about job growth has been outpacing GDP growth. Maybe they're moving towards each other. We are going to be seeing slowing. I would have thought that regardless of what this number was, but I wouldn't panic about any one number.
The headline number is a weak number, but obviously the internals tell a little bit of a better story, and certainly wages continue to go up is certainly a positive. From a market standpoint, I would look at this as it doesn't really change the trend. We know we are cyclically getting a little bit weaker. We had a pretty big pullback and tightening in the fourth quarter, so it's not shocking to see the market softness a little bit.
All right, with that, we move across the Atlantic Ocean, and the European markets out there, they ended lower as the investors digested a weak US jobs data and the announcement of more ECB stimulus coming in. All three major indices ended sharply in the red. The FTSE, CAC as well, FTSE and the CAC lower by about 0.75% each, while the French index lower by about 60 points. More importantly, the big data point coming in from the US from Europe over the next 3 weeks will be the uncertainty on Brexit, and that is keeping the sterling in check. In fact, the pound fell in the previous trading session. That's as the Brexit date appears is around 3 weeks away from now, with no deal yet being signed. So that is something that will cause some sort of concerns among the investor community as well. But the emerging markets, they outperformed. We saw the Brazilian index move high and move faster on Friday's trading session, about 1% gain coming in, nearly 1,025 points added on that index.
All right, taking Mangalam's point forward, let's talk about the currency space then. Dollar retreated on back of a dismal US jobs data. Sterling dipped sharply and hit a 2-week low as doubts existed over whether Europe and the UK could break the Brexit deadlock.
In the world of commodities, crude oil prices fall as jobs data disappoints and ECB slashes growth rates. Brent is down over 1%, trading around the $65 per barrel mark. NYMEX crude too falls to around $56 per barrel.
But it's time for a quick break. Up next, we'll get you all the cues and news you need to know for trade this morning.